Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a senior manager here at Schwab, and this is Trading Calls, Trading Covered Calls and Short Puts. And this webcast series is all about selling options. And when we sell options, we're exposing ourselves to the risk of assignment on those contracts. And so what I wanted to talk about today is what are some of the factors that might contribute to the increased risk of assignment. If that is a concern for the traders, this is going to be an important video. Hopefully you'll watch the entire thing. But before we can get into those factors that might contribute to the early assignment of a short option, I want to first of all say hello to everybody who's already joining me out there in YouTube land. Great to see Cynthia B. and Will, Dave, Ricebird, Ted, Bob, Robert, Eva, everybody else. Thanks for joining us week after week. We really do appreciate your attendance and your contributions in these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, enjoy the presentation. But be aware that you're invited to join us in the live discussion. This is a Monday webcast series. Kicks off promptly 2 Eastern time. We'd love to have you here in the live stream audience. Also want to let my live stream audience know that Barb Armstrong is going to be hanging out in the chats with us today. She's going to be addressing any questions that I can't get to, as long as they're not too far off topic. Barb's there to pick up my slack. Everybody knows what a great wealth of knowledge that Barb brings to this discussion. So thanks for being there, Barb. It's very much appreciated. But Barb and I would also like to issue an invitation to all of you watching, whether it's live or on the archive. If you have an account with X, make sure that you're following your favorite presenters there, because it's really the best place to connect with your favorite presenters, and it's a place where we have the opportunity to communicate with you in between these live streams. So you can find Barb there on X at Barb Armstrong CS. You can find me on X at Cameron May CS. All right, so with those things accomplished, let's get to some disclosures, and then we'll get to the discussion. So first thing, of course, we need to do is bear in mind some important information relates to risk. This is it is important, so keep your eye on this stuff. Options carry a high level of risk and are not suitable for all investors. Schwab does not recommend the use of technical analysis as a sole means of investment research. All investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right, so let's set the agenda for the day. So in this webcast series, we place example trades, and in this case, they are covered calls and short puts. So we have some positions in our example portfolio we need to go take a look at. Now, a couple of those kind of brought to mind the thing that I wanted to talk about today, which is assignment, specifically early assignment of contracts. Can it happen? Yes. What might increase the risk of that happening? What are some of those factors that might contribute to that? So as we're looking at those new positions, or as we're looking at those existing positions, maybe a little bit after, we're going to talk about what might increase the risk of assignment. And have really 3 big factors that might contribute to that. And before we're done today, though, we're going to be adding a new position to the portfolio with that new knowledge about early assignment risk. And anyway, that should wrap it up nicely with a bow. So let's go right to our Thinkorswim desktop trading software platform. Right now, we have 5 positions, 4 existing covered calls, and then we have 1 just long stock position. So on AbbVie, we own 100 shares of stock that we bought at $190.71, currently trading at about 205. So here, let's go have a look at a chart of AbbVie. You can see right here was when we entered that position, bought 100 shares at $190.71 with the ultimate objective to hopefully turn this into a covered call sometime down the line. We entered those shares because it appeared that price had just moved above a potentially important area of previous resistance. You can see there's been a price ceiling between 180 and 185 for about the first 5 months of the last 12. We pushed up and through that, and then it became a new price floor for the next 3 or 4 months. And then it was a price ceiling again. We just pushed through that apparently important fulcrum point for price around 185. And for some technicians, they may think, hey, this might signal that the stock is about ready to make a run. So we bought some shares, didn't sell an immediate covered call in order to allow those shares to run if they're going to. But now we've run some distance. We bought down here around 190. The stock is now up about $15 from that entry price. But it's interesting where we find ourselves as we open this discussion. right up against previous all-time highs on ABBV. The price has never been managed to finish a trading session above about 206. That's only about $1 above where we are. And under these circumstances, some traders might see that as an opportunity if their conviction is that the stock doesn't seem likely to go much higher in the near term. Well, if price appreciation isn't expected, maybe it's time to bring in an income, some potential for income. So what we're going to do now, let's sell a covered call up here at or around the 205, maybe go up to the 210 level. Now, AP 514 says if the trader also has a stop in place on their stock position, maybe they could move that up. That's another thing that could be done. Yep, we don't have one on this position. But what we are going to do today is, how about we take a look? Let's drag this down a little bit. Let's see what we can get maybe for selling a 210 call right up here. Let's maybe carry that out to that March 21st expiration. This obviously would be entering into a contract where someone else is going to have the right to buy shares from us for $210. So let's go look at the 21st of March. I'm sticking with the monthly, the traditional third Friday expirations. They tend to be more liquid than the weeklies. Other than that, other than expiration dates to keep in mind. Nothing inherently wrong with the weeklies, but I'm going to go out here to the third Friday monthly contracts, 21st of March. Let's see how much the 210s are selling for. Those are between 217 and 231. Maybe we can get, maybe 2.25 on our $200 stock position. That's a little bit more than 1% over the course of the next 25 days. AP 514 is saying, are you going by delta? I didn't specifically in this case, but for some traders they do. They'll look at that delta, which can be an indication of leverage, how much the option might make or lose on a $1 movement in the stock. But it also shows us the relative probability of the contract being in the money at expiration. So about a 33% chance in this case of being in the money, or about a 67% chance of being out of the money, which would be the objective of this trade for many traders. So let's look at that 210. Let's click on the bid price to sell a call. Now, in my portfolio, you'll notice it only brings up an order to sell one contract, and we own 100 shares, so that's a nice fit. To be a covered position, we have to own 100 shares for each contract that we sell. But in the default metrics, this would actually bring up an order to sell 10 contracts. I just changed my default to just sell one contract. So we're going to sell the 21st of March, $210 call at a price of between 218, 224. Let's see if we can get 220 for that. All right. Not going to demand all the way up to maybe 2.25. Let's try for 220. Still not there's still not a guarantee that we're going to be able to sell this contract. Anytime we enter a limit order, there's that risk the order might not fill. But let's click confirm and send. Selling that one, ABBV, 21st of March, 210 call, 220 limit. That would give us a maximum profit on the call itself of $220. The maximum loss would be an infinite max loss potential if we didn't already own the shares. But this is a covered position, so we don't have an infinite risk potential on this one. There is a commission to be paid that'll chip into that credit a little bit if we get filled. We're asking for a minimum net credit of $219.35. Let's send that off. And can we get filled? Let's go to our working orders. 220, 226. Yeah, I think, let's see if paper money's a little bit forgiving. There we go. Just filled on that at 224. So we've entered into a new contract. Someone else has the right to buy shares from us anytime for the next 25 days for $210 per share. When selling covered calls, the trader has to be comfortable with the fact that they are not in control of whether the contract gets assigned or not. Now, they can look at a few factors that might increase that risk of early assignment. Could they potentially address those and hopefully decrease that risk? Yes, but it's always in someone else's control whether those contracts are ultimately assigned or not. So we're into that covered call. Let's look at our IBM position. Here, we bought some shares at 249, sold the 21st of March 265 calls. So our preference here would be for the stock to go up above 249, which helps our stock ownership position. but to stay below 265, which might allow that call to expire worthless. And look at where that thing is hovering right now, around 262.5. Here's how things look on a chart. Okay, I was reading a comment here, AP514. Okay, all right, looks like you're talking about a different trade. There we go. Anyway, so with IBM, we entered the stock position here at the same time. On the same day, we sold a call up here at the previous highs around that 265 mark, thinking maybe price is set to rally, and it has now. That's nice to see. We came right up to that 265 mark, and almost like textbook behavior when you're trying to teach this stuff, we're starting to peel away from that. So that 265 call remains out of the money. That doesn't mean that it can't be assigned. I will say, in paper money, early assignment's not a thing. Doesn't happen. Nobody's assigning fake contracts. But in real money, yeah, early assignment can happen even if a contract is out of the money like these are right now. But right now, I'd say that position is behaving just fine. It's profitable. AbbVie also profitable. We're going to let that one continue to work. Let's skip over Johnson & Johnson and look at the other two. Eva, I don't mind the discussion, the sidebar discussion at all, as long as it's relatively on topic, that's fine. Anyway, Wells Fargo bought 100 shares at an assumed price of 70. Now, I did a little bit of a paper money magic here because what we wanted to talk about was using calls as possible exits. This wasn't actually the one that we did that on, but I assumed a purchase of $70 and made it so in the paper money account, even though I didn't do that on camera. So let me just show you that on a chart. So if we go to Wells Fargo, we had our discussion here on this day. I assumed we were among those traders that maybe bought the shares back down here around $70. So I created a stock position at around $70, but with the intention of selling a call against that up here at resistance. In any case, if the trader owns the shares at 70 and they sell a call at 80, they just need to be comfortable that that call can be assigned at any time. Now, the stock actually rallied subsequently above 80, but it's pulled back. We're back down around that price ceiling, pretty much where we suspect it might hold. Let's see if it continues to do that. But yeah, that position is actually doing just fine as well. You can see our call, which we sold for 172, is now only worth about $1.26, so that's working in the right direction. Finally, well, not finally, J&J will be finally, but XOM is a stock position where we did buy this during the webcast. Bought 100 shares at 106.92. Sold the 115 calls, so the preference here is for the stock to go up, but stay below 115, and right now it's around 112. So that seems like it's behaving just fine too. So bought the stock and sold the calls on this day. No, I'm sorry. Bought the stock down here at support, waiting for it to rise up close to resistance, which it seemed to be right here. So on the, was this the 10th? Yep, 10th of February, we sold that 115 call up above that price ceiling, up above that resistance. And since then, the stock's kind of waffled around. It's made its way a little bit higher, but still holding below this resistance. That call still solidly out of the money. That's still behaving. That position's doing well. We're going to let that one continue to work. But the final position is our Johnson & Johnson trade. With this one, we bought 100 shares at 142.5, sold a 155 call. So here we'd prefer for the stock to go up, but to stay below 155. It went up, paid no attention to 155, and just blasted on through. So here's what's going on with our Johnson & Johnson position. And this one, I think, is going to lead to our discussion. When a trader gets into a short contract, either selling calls or selling puts, they have to be comfortable with the fact that those contracts can be assigned at any time as long as we remain in those contracts all the way up to expiration. Now, if they're squeamish about that at all, maybe what they can do is keep their eye on a few factors that can reduce that risk of early assignment or increase that risk of early assignment. So let's talk about those. So really about three things that can really increase the risk of early assignment. And one of those we're seeing on Johnson & Johnson right now. So we bought 100 shares right here at 142, sold to 155 calls. So we prefer the stock go up, but stay below 155. Because if we think about this, someone has the right to buy shares from us for $155. As long as those shares aren't worth $155, they don't really have much motivation to pay us $155 for those shares, even though they have the contractual right to do so. But if the stock goes up above that strike, now they're getting a discount on the shares. Look at where the stock is right now, 163.5. Someone out there, conceptually here, has the right to buy shares from us for $155, and those shares are worth $163.5. They have an $8.50 discount. They have an $8.50 advantage against anybody else in the market to buy those shares at a lower price. So we have a term for this. We call this in the money. That contract is in the money by a distance of about $8.50. This is one of those things that can certainly dial up the risk of early assignment. And I think it just makes sense. Makes sense that it's not nearly as likely that if the shares aren't worth as much, that the other party decides, you know what, Cameron, I'm going to go ahead and overpay you for those shares, just maybe out of the kindness of my heart, right? They still could. I'm not saying they won't. Every once in a while it happens. I'll bet there's somebody here in attendance with 182 people watching who's actually had an out-of-the-money contract assigned early. It does happen. But going in the money, in this case, on calls, it's if the stock price rallies. On puts, it's if the stock price drops. But the greater the advantage for that trader to buy the shares at in this case, a discount to current price, the more likely it is for early assignment. Cynthia B says the only reason it's not got assigned is because we're in a paper money account. That's an excellent question, Cynthia B. It's an important question you just asked, because I had the impression when I first started trading options, oh, so if my call goes in the money, it's going to get assigned early, right? Why would they not? No, actually, even when a contract has gone in the money, it usually isn't assigned early. I tried to get some numbers for this because it's a natural question to think, well, so what's the likelihood? Can you put a figure on it? I looked it up. I did some Googling. I haven't done this recently, so I wanted to see what the current numbers were. And I saw it repeated a couple of times. About 7% of contracts are assigned early. I don't have anything other than some quick Googling to back that up. So take that with a strong grain of salt. I don't know exactly how often contracts are assigned early, but I do know it's not as often as we might think. Because what I learned after my initial impressions was it's not usually in the trader's mathematically best interests to assign early, even when the contract has gone in the money. Let's do some math on this one right now. Let's come over here. And so let's put ourselves in the shoes of the owner of this 155 call. They're sitting there rubbing. My dad used to do this when he'd get excited. Does anybody else do this? My dad, when he'd get excited, would rub his hands. So the owner of this call is rubbing their hands. Ooh, look at this. I have Cameron on the hook. I get to buy shares for $155. They're worth $164 right now. We just ticked up a little bit further. Surely they're going to do that at any moment, right? Actually, probably not. Here's why. If we go look at the trade tab and we look at those let's see, it was the 155 calls. Look at the current value of those calls between $9.75 and $9.95, about $9.85. So let's put ourselves in the shoes of that call owner for just a moment and walk through two different choices that they have, among other things, but let's boil it down to two. They have the right to buy shares from me, conceptually, for $155 per share. If they did that right now, they can buy those shares for $155, sell those for $164. That's $9 of value. Do you see that? Yeah. I'm rounding this off a couple of pennies, but about $9. So that's pretty good. But what else could they do that actually doesn't involve assigning, go through the hassle of stock ownership and the liquidation of the shares? What else might they do? Well, maybe they just sell the contract they own. That contract is worth between $9.85 and $10. So instead of assigning it and retrieving $9 of value, maybe they just sell the contract to somebody else, and maybe they get $9.85, $9.90, maybe $10. Yep, it's almost always more in that option owner's best interest to just sell the contract, and it's usually an easier thing to do. So if it's more profitable and it's easier, yeah, that's what's done most of the time. But in this case, it's a fairly clear distinction. $9 of value versus $10 of value. That's a pretty clear-cut case, and you can see why somebody wouldn't want to take the less profitable exit on this trade. Well, that distinction starts to blur a little bit the more the trade goes in the money. Let's put ourselves in the shoes of, let's say, someone who, instead of owning the stock to write let me just repeat that sentence. Instead of having the right to buy shares for $155, maybe they have the right to buy shares for $145. Okay. Let's walk through that same math. If they assign the contract, they buy the shares at $145, they sell for $164, that's about a $19 value. Or they could sell the contract for about $19.50, maybe $19.75. There's about a 50 to a 75 cent difference between those exits, whereas we had about $1 difference between the original deal. On our original deal, somebody would be shortchanging themselves about 10%. Ouch. On that deal. On this one, it's more like 5%. However, if you'll notice in both of those scenarios, which one is mathematically the better exit? It's selling the contract. They made their money, sell the contract, let someone else deal with that, and they're out if they're able to exit. Not every time can a trader smoothly exit a contract, but let's say they do that. That is a mathematically superior exit than assignment. But what I didn't understand up front when I first learned about trading options was just that. I just thought, oh, so if a contract goes in the money, it gets assigned. Nope. It can. The risk goes up because there's less for the trader to lose in assignment, but there still is something to lose. So let's put a precise figure to this. There's actually one variable, as we talk about the other two things that can increase the risk of early assignment. It really boils down to one thing that can increase the probability of early assignment when running the numbers on options, and that is the extrinsic value of the option. With our 155, it had basically $1 of extrinsic value, which is the difference between the discount they're getting and the value of the option. And the 145, there was about 50 cents to 75 cents of extrinsic value. So as that extrinsic value shrinks, the likelihood of early assignment can go up. So what we've just discovered here is one thing that can shrink that extrinsic value is as we go deeper in the money, the likelihood of early assignment goes up. So that's number one. What's a second thing that can increase the likelihood of early assignment? Well, getting closer to expiration. It's having an impact on the same value of the option. It's the extrinsic value, but this trader that we're in a contract with right now, and again, I don't like to say it that way because we're not truly in one locked-in contract with one other person out there in the marketplace. I just think it's easier to think about it that way. Two parties involved, and that's it. But this 155 call still has 25 days till expiration. And the contract right now is about $9 in the money. But if the stock continues to rise, this trader can just sit on their hands and just wait to see, well, can it go up further? I don't even have the risk of ownership yet, that other trader might be saying to themselves. If the stock keeps going up, it still has 25 days to continue to build value here. Well, let's look at that. Let's look at the same strike. What about these contracts that are 4 days from expiration? Look at that 155 strike. If someone owns those contracts, if somebody owns a 28th of February contract instead of the 21st of March, they still have the right, in this case, to buy shares for 155. They're still getting a $9 discount on the stock, but look at the value of the option. So they could exercise their right to buy shares for 155, sell those shares for close to 164, and there's about a $9 retrieval of value on that exit. Or maybe they just sell that option to someone else. They might be able to sell that between $8.85 and $9.20. Maybe they are able to sell that option for $9. Notice there's virtually no difference here. We've gotten closer to expiration. There's not as much intrinsic value that a trader would be surrendering if they were to assign the contract versus to sell the contract. And so that can really leave it as more of a toss-up. Hey, might as well just exercise the contract. So that can increase the likelihood of early assignment. So going in the money, and the deeper in the money, the greater the risk of early assignment, or as we get closer to expiration. And if you combine those two powerful variables, it kind of has an enhanced effect on the likelihood of early assignment. If the contract is deep in the money and there's not much time left, then there's probably not going to be much intrinsic value in that contract. And then it's kind of a wash, whether we buy the stock using the contract, assign the contract, or sell the contract. All right, so those are two variables that can increase the risk of early assignment. What's a third variable? I'm going to let that one sort of be a cliffhanger for just a moment, because we need to go deal with this position. When I say deal with it, there is no risk of early assignment in paper money, but there is a risk that this trade, which is doing so well right now, we're up $1,346, it could fall apart. Something that goes up this rapidly and puts us well into the profit could fall just as rapidly, and we could surrender that profit. And you might think, yeah, but maybe we'll make more money if we just stick with this position. There's actually not very much left to be made on this trade. And somebody was out there saying, maybe we should get out. Oh, Eva, you're talking about exiting with an 80% profit? Yeah, when we got into this deal, we bought the shares for $142.50. And then agreed that someone else can buy those from us for $155. That puts a cap of $12.50 that we can make on the shares. Now, in addition to that, we collected a $1.90 premium from selling the call. So we have $12.50 that we can make from the stock per share, plus another $1.90. My math says that's $14.40 if this trade goes optimally. Or in other words, if we get called out, that's how much our realized gain would be while setting the commissions out of that equation. So $14.40 per share on 100 shares is $1,440 is the most that this trade could make at expiration. Look where we are right now. We're at $1,350. We haven't made all the money yet, but we're pretty close. So there's not very much reward left, but we still own the shares. If they collapse, we could lose that. So I'm going to close this position out. I'm going to right click, create a closing order, and sell this covered position. Let's this brings an order up to sell the 100 shares, to buy the one contract back that we are in. Looks like we might be able to net between 154.04 and 154.16 as we exit this trade. Let's say that we're willing to sell out of this position. Let's go right to the natural, just to get out quickly if we can. Still a limit order. It's not a guarantee that we're going to be able to exit, but let's confirm and send. Going to sell this covered stock position, covered call. I call it covered stock because that's what Thinkorswim calls it. Anyway, it's a covered call. We don't pay any attention to max profit or max loss. This is a closing transaction, so this doesn't apply, but there is a commission. But let's see if we can get out, realize something along the lines of a $1,300 profit. And we did. We're out at 154.05 net between having to pay to buy the callback, but now we can also sell the stock. And we've just realized about a $1,300 profit on that Johnson & Johnson position. So nice. All right. So let's get back to our third reason that early assignment risk can be elevated. Going in the money and going deeper into money. Number one, having fewer days till expiration. Number two, especially if we're in the money, especially if we're deep in the money. Number three is if there is a dividend upcoming. So when we are in a covered call, we've sold someone the right to buy our shares. Well, they may decide to assign that contract and buy those shares, especially if there is an ex-dividend date before expiration. They need to get their hand on those shares, their hands on those shares, if they want that dividend. Now, that's still going to come down to a decision between the trader is going to have to pay for the shares, but they're also surrendering the value of their extrinsic value of their option. So commonly, the decision for the party trying to decide whether to buy the shares and get the dividend is, well, is the dividend going to pay me enough to compensate for the surrendered extrinsic value, whatever that might be, 50 cents, 75 cents, $1, whatever it might be? Does the dividend exceed that? Lily says, how far can you roll covered calls? It's a little bit off topic there, Lily, but I don't mind addressing it as far out as you want, all the way to as far as the contract expiration cycles reach, so maybe years. So anyway, yeah, dividends can increase the risk of early assignment. Now, how much does it increase the risk? It still remains less common than not to be assigned early. Even if a contract is in the money, even if it's deep in the money, even if it's close to expiration, even if there's a dividend to be paid. Because even with dividends, there is that adjustment that's made on the ex-dividend date where theoretically it's not much of an advantage for the trader to buy the stock before a dividend just for the purpose of getting the dividend, because they get the dividend and then their stock price goes down by the same amount. That's a wash, theoretically. Obviously, other factors can drive prices in, larger increments in a positive direction or negative. But yeah, dividends can increase that risk. So we need to be aware of that. So a trader who is trying to minimize the likelihood of early assignment, what are some of the things that they can do to hopefully minimize that? Number one, sell out of the money options. Number two, sell them further away from expiration. Number three, don't sell if there's a dividend between the time we enter the contract and expiration. Eva says, Cam, if we have more than one contract and our buy limits are 5 cents or less, is each one treated as on its own rather than adding them together for commission purposes? Yes, Eva. Yeah, it's the per contract price. Yep. Good question. All right. There we go. Now, one note I want to make about dividends is because we've been looking at this sort of through the lens of a covered call. Dividends can also increase the risk of early assignment on a short put after ex-dividend date. The concept there being the price adjustment after the ex-dividend, because when we sell a put, someone has the right to sell shares to us at a fixed price, right? Well, after the ex-dividend date, they have their dividend, and maybe at that point they decide, let's sell those shares, we don't need them anymore. So that can raise the risk. So if we understand those variables, the trader can start to take proactive measures, hopefully to minimize that risk. They do not have it within their power, though, to eliminate the risk, or to eliminate just the possibility that somebody gets a wild hair and says, you know what, forget all these factors. I'm just going to assign the contract just because I want to. That's another thing that someone else can do. Whether it's mathematically in their best interest or not, whether it makes any sense, what someone else does with their contracts is not required to make sense to us. So hopefully that was an interesting discussion of the risks, the factors that can elevate the risk of early assignment. But let's add a new position to our portfolio, okay? We've already sold a call against ABBV. We've exited Johnson & Johnson. We've actually just freed up a little bit of capital. Let's go spend some of it. Go commit some of it is another way to think about that. Let's have a look at what's going on with the markets first. So we've seen stocks just rallying now for a long time. The last 12 months have been great. It goes back substantially further than that. Recently, over the last few days, prices have pulled down, but could we possibly be getting a little bit of a hammer pattern here, right around that 6,000 mark on the S&P 500? That's a possibility. But as our technical trader here is starting to make a plan, is it a good time to get into a new covered call or a new short put? Both are bullish strategies. Do the markets appear to be bullish? Well, they haven't been for a few days, but overall, let's say that our trader still has the conviction that prices are set to continue to rise. And let's add one more position here for March 21st. Next time we meet, we're going to start moving out maybe into April for our trades. Yeah, Eva says, lol to Cam, let's go shopping. Sort of what we're doing here, right? But let's say our trader still feels all right, thinking the stock price might rise. I also noticed, let's just do this quickly. If we look at a couple of the more commonly used moving averages, like let's say we look at a 50 as a possible trend, and we look at a 100 as a possible longer-term trend and maybe even support and resistance, both of those are still rising. It's interesting that price on the S&P, the levels have come right down to that 50-period moving average, and when we've gotten down to 100, that's been a reversal point as well in the past. But overall, let's say that our trader thinks things still look bullish. Let's go do a new bullish trade. Could do a covered call. We already have a bunch of those. Let's do a short put. So actually, let me go back to our charts here. And I wanted to look at a stock, Procter & Gamble. What's going on with Procter & Gamble recently? I saw this kind of fading. I thought maybe I might move to a different stock, but I'm going to stick with it. Let's get rid of our moving averages. They aren't part of what I wanted to discuss right now. But what PG has done recently is kind of interesting. It's been struggling at about that 170 level for a while. Just yesterday, or on Friday, we pushed up through that 170, and even with today's activity, we're still holding above 170. And just like with our initial ABBV position, maybe our trader thinks this is a time when the stock is likely to start to rise again. Well, when a stock is set to rise, we could buy calls. That's not what we talk about in this webcast, or we could possibly even sell a put. What if we were to go to our trade tab, and let's look at the 21st of March and look to sell a put. Now, how did I qualify Procter & Gamble, aside from just what's happening with the price chart? What are some of the other considerations that traders might have? Well, they might consider price per share. Obviously, if we're getting into contracts on very high-priced stocks, those carry some big obligations that we have to be aware of. Number two, the liquidity of the stock can play a role. With illiquid stocks, their options tend to be liquid. They tend to not be very, very favorably priced as far as the bid-ask spread is concerned on their options chain. It can make them harder to trade profitably. Also, maybe a trader who is in this for income, whether doing covered calls or short puts, dividends might also be a consideration. And this is a dividend-paying stock. I think it pays semi-annually. Not a huge dividend, but those are among the factors that traders might consider. But I'm thinking for this example, what if we go look at, what if we sold maybe even the 167.5 put? Let's do this as our example trade. Now this is going to be in, oh my goodness, I shouldn't try to do two things at once. Our example trade is going to just be a short put. It's a bullish strategy. And for this one, let's sell the 167.5. Now, what are we doing here? One thing that we're doing is we're going out of the money. What's that doing with the probability of early assignment? It's reducing that risk. It's certainly not eliminating it, but reducing it. The trade-off there is as we go further out of the money, the lower the potential premium. We're also, instead of going right up close to expiration, going a little bit further away from expiration. That extrinsic value acts as a sort of buffer, again, not a guarantee, but a bit of a buffer that against early assignment risk. And also, for some traders, they might also think that doing the technical analysis may help with the probability, help to minimize the risk of early assignment, breaking through a price ceiling. Maybe if the stock is less likely to go back down below that conceptually, the trader might think that's going to help reduce the risk of early assignment. There are some things that do reduce the risk, like adding more time, going further out of the money. And there are some things that are, for the trader, they might think it reduces the risk, and whether it does or not, we'll see. Technical observations on a chart may or may not help reduce the risk. In any case, yeah, Laura. Oh, does it have a quarterly dividend? Thank you, Laura, for checking that. Anyway, looks like we get maybe around $1.60 for this. Let's see if we can. That's about 1% for 25 days. But I'm going to click on the bid price, and let's just do the one contract here. Selling that one contract for 167.5. 155. Let's say we're willing to settle for even just 155. There we go. We'll just lock that in here. Let's click confirm and send. Selling that one short put for $1.55. That gives us potential income and profit potential of $155. We're getting paid $155 if this fills at that price. But in exchange, we have an obligation. Someone has the right to sell shares to us for 167.5. If the shares are worth more than that, they're unlikely to, but there's still that risk of assignment. But yeah, commission to be considered here. We're just doing one contract, so one commission. Let's send that order off and see if that fills. All right, looks like we're right in the neighborhood there. I think we have a good chance to get that filled. But while that's waiting, we've accomplished what we set out to do today. I wanted to have a good in-depth discussion of the factors that can increase the risk of early assignment on options. I hope that was an insightful discussion. For some of you, it's going to be familiar territory. For others, though, at some point on everybody's learning curve, that can be an eye-opening sort of revelation to really understand how early assignment works. So hope you enjoyed that discussion. This is what we do on Mondays. I also hope that you'll put it in your personal calendar to join me each Monday. As I let you go enjoy the rest of our educational offerings for the rest of the day, I want to make sure that you're aware of other resources that you have. But first thing, make sure, if you haven't done this already, go down below the video window right now and click on the subscribe button if you haven't done it already. It only takes a moment, doesn't cost anything, but that'll subscribe you to our YouTube channel. And that's where we host our playlists of our previous webcasts. So you can find the playlist there. You can join our live streams there. Another thing that I would suggest, though, is that you follow Barb and me on X. If you have an X account, make a mental note to go give us a follow right after the webcast. You can follow Barb there at Barb Armstrong CS. You can follow me there at Cameron May CS, but it is the very best place to connect with your favorite presenters in between the live streams. And also want to thank you, about 200 people watching. How many people have clicked that like button? Already 65 people have clicked that like button. That's very much appreciated. Thanks. If you have a habit of doing this, it's very much appreciated. Each time you watch one of our webcasts, if you like it, then give it a like. Click that thumbs up. That sounds like applause to your presenter. It's like a pat on the back for their efforts, but it also gives that webcast a boost in the YouTube algorithm and help that webcast find a wider audience, so more people can understand the variables that can increase the risk of early assignment. So everybody, thanks for everything you do for me. I'll be back again next week, try to deliver more value for you. I'll look for you between now and then, in my other webcasts, I have something new every day of the week. I'll look for you in those webcasts. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.